Well, welcome back. We're looking at a sell-off in Deutsche Bank continuing. Investors around the world watching the stock this morning. It's slumping on a report that Germany will not provide any aid to the bank if it's needed. The decline now weighing on markets across the world as well. Joining us right now is Stephen Wieting. He is the Citi Private Bank Global Chief Investment Strategist. And Stephen, it is wonderful to have you on the program this morning.
Thank you.
How worried are you about Deutsche Bank and its impact?
Look, I think you have to worry about this in the context of continuity of European politics. They've just had Brexit. And aside from that, there are these issues in Italy where you have almost as much debt as Germany generally, and you have the German government hoping that other governments within the Eurozone won't go back to the bailouts that we had during the crisis years while they still have their own issues remaining.
Yeah.
So this whole issue of just governance of the Eurozone and how long you'll have this process of going from lurching from one crisis to the other, that's an issue.
But Kevin, as we were just discussing, the derivatives portfolio is significant at Deutsche Bank. If that collapses, if they are forced to sell some of that portfolio, does that impact the broader industry?
Well, this has been the biggest overhang, I think, for the markets in general, is that Deutsche Bank does have a large derivative book. And the problem is it's a crisis of confidence that happens all of a sudden. So what would happen is all these assets would leave the bank, counterparties would move away from them. And the worrying thing about the derivative book as well is the collateral that backs a lot of the derivatives they have. So it's a very complex, convoluted situation where everybody just wants to step back from it. So if something does happen to Deutsche Bank, it would affect the entire sector of banking over in Europe. And because it is a crisis of confidence, nobody will want to step in and do anything.
You agree with that, Stephen?
I believe that the ability for the financial sector to push problems off balance sheet, to cope with these sorts of issues in a way, is not the same place that we were in 2007.
Okay.
Yet at the very same time, you have these issues of negative interest rates in the Eurozone, the ongoing growth model. These things, I think, are more have more primacy than the issue of whether or not we have derivative exposures, which we do across the whole world.
In terms of there's a story in the Wall Street Journal that we're going to have profits down for the 6th quarter in a row.
Don't believe it.
Don't
Quite
believe
simply,
it.
no.
So so the expectations are wrong.
Yeah, I think that they're wrong, and they've been wrong every single quarter since the 3rd quarter of 2009. Every single quarter since the 3rd quarter of 2009 has had an upward EPS surprise of magnitude. About
but that's after it was taken down. So
from lowered expectations?
Yeah, expectations keep getting lowered and lowered and lowered.
No, but you're now at the point where EPS estimates show negative 2%,
right,
and you'll end up being marginally positive, where you finally have the drag from energy, which has been the most substantial drop in profits. And away from that, you haven't had a drop in profits. You haven't had a boom by any chance, but you've had marginal small gains in EPS ex energy over the past year. And by the 3rd quarter, I think that you'll see that that drag is small enough that broader profits will be positive, not negative.
But isn't it worth mentioning that the 3rd quarter was the time when we were supposed to see profits turn, that we were supposed to actually see growth again, and you say we will, but the expectations are still for a decline.
Yeah, I think the EPS estimates for the quarter just passed are chronically too low, and EPS estimates 1 year ahead are chronically too high. Next year, you'll not see a 13-14% EPS gain. These have been biased up by about 9 percentage points over long periods of time. But, you will see, just as we've seen since every single quarter since the 3rd quarter of 2009, that when companies report, they will beat, and this time they'll be marginally above
We
zero.
did hit peak earnings 2 years ago in 2014, and one of the issues that when we're talking about earnings, yes, earnings have been able, we can manage earnings upwards, right? But what we can't manufacture is growth, and we're starting to see revenue growth has been the biggest issue, I think, that companies are trying to address, right? So you're seeing it happen where they're going out there acquiring other companies because they can't do it organically. And I think one of the issues that could happen is that we've got this slow global growth, that you're seeing a lot of these managements come out and say it's not that great out there, and they're actually trying to manage people's expectations down. The one thing I think the market could rise on, though, is that comparables to earnings last year are so much easier to beat now.
Look, it's not a good global growth environment. It could be much worse. And so if we manage to maintain the expansion that we do have, and we no longer have a 6 percentage point drag, a 60% drop in the energy sector, and again, this is a market of stocks. There are many companies that still have rising earnings, and there are those that don't. And if you just take a look at it in the aggregate, you're embedding this massive, massive drop. The one industry that is fully in recession is the petroleum sector. Globally, it's important. It is down. It's very, very far apart from where other earnings and whether other companies are. I think it has a chance to rebound. And under the right circumstances, we'll get a marginal extension of this profit recovery cycle that could take us above where we were, as where you said the peak was.
Uncertainty over the election? How does that play into it?
It's a big issue. And the important thing is regime change and what it means for the economy. I think it's, not always cause and effect, but the truth is we've had 11 recessions since World War II. 8 of them have overlapped a new U.S. president's first year in office.
Wow.
And in some cases, a weak economy can drive a regime change. In some cases, policy change, policy uncertainty can knock down an economy. So this is a time where I have to be careful about that.
And we're long in the business cycle as well.
Absolutely, and that's been a concern for us. It's the reason why we've had a somewhat more risk-averse asset allocation this year going into next than we would otherwise.
Yeah, we didn't talk about regulation, but I think that's part of this issue on this pressure on corporations right now. Stephen, great to see you.
Thank you so much.
Thanks so much. Stephen Wieting there from Citi.